Good morning, everyone. We will allow another 2 to 3 minutes for the others to join in, and then we will kickstart with today's session. Okay, it's 9:33. I think we can get started. So good morning once again to everyone. My name is Surender Kaur. You can call me Suri, and I'm going to be your faculty for Enrolled Agent Paper 3. Just to give you a little bit background, I'm a certified public accountant. I work in US compliance, and I work as a senior manager in one of the uh, MNCs here. So that's a little bit about me. We have discussed about the enrolled agent certification in our orientation last week. So I'm hoping that everyone will be aware as to what we expect to learn from these classes. But if not, then let me tell you that enrolled agent, in order to be an enrolled agent, you have to clear 3 papers. So the third paper, that is representation, is what I am going to teach you over the period of a month or so. And we will be studying together over the weekends. All right. How the classes are going to be structured? I have kept a 2 hours class, but mostly, we will try to wrap up in 1.5 hours. So the first 1 hour, I will take time to explain you the concept. The next 15 minutes, we are going to do some questions on the concepts that we would be covering. Like we will go through the questions together, and then we will leave the last 15 to 20 minutes of the session to take up any questions that you may have on the content that I will cover for that particular day. And you may also come back with those questions later in the next session if it was not answered. Sometimes I may not have all the answers, so I will take up that question and come back to you in my next class. All right. So that's how the structure of the class is going to be. For the benefit of everyone, everyone will be on mute. You do not have the option of unmuting yourself because we have a large audience, and it just creates a lot of confusion if people are trying to unmute themselves and ask questions. So I would request everyone to please put your questions in the chat window, and it is best to put your questions in the last 15 to 20 minutes. So because when I'm teaching or explaining the concept, I may miss out on looking at the question that you may put in the chat window because it's difficult to multitask. And also, it is better that you keep those questions for the last 15 minutes so that I don't miss out on those questions. All right. So that's how the structure of the class is going to be. If you're able to hear me clear and loud, please put your response in the chat window. You can either put a yes or a Y. Okay, all right, excellent. Thank you so much. Thank you so much for your responses. So today we are going to start with our first topic, that is preparing returns. All right. So what are we going to cover under this topic? We are going to cover preparing returns. That means who can prepare returns. Then we are going to cover about the positions and disclosures. So we will come across lot of language that is a law language, and we will come across a lot of tax terminologies. So every time we bump into a law language, or every time we bump into a tax terminology, which is, I guess, will be new for everyone, we will try to decode that and try to understand what it means. Because we will speak about the positions and the disclosures, here we are going to understand certain definitions. So we will discuss about what are the different standards that are laid down by the Internal Revenue Service, or I would say the Treasury under Circular 230. We will discuss about certain positions that you can take on the tax return. We will also discuss about the preparer's penalties. So remember, when you're getting compensated to do a work, there are certain penalties that can also be associated with it if you do not do what is expected out of you. So we will cover the preparer penalties. That means someone who's preparing the returns, what kind of penalties they can be assessed if they do not abide by the rules and regulations. All right. Then we will discuss about the statute of limitation. Now, when we speak about statute of limitation, it is again a terminology. It's a law language. So that means that what is the time period for you to retain certain information? What is the time period for you to claim a refund? What is the time period for you for the Internal Revenue Service to come and audit your tax return? So statute of limitation means that what is the how does the law defines as to the time period on which you can take up certain actions. And the last topic that we are going to cover in the first chapter is the e-filing process. Now, because we have advanced ourselves technologically so much, 90% of the returns are being e-filed. So when we have the e-filing process, we will understand what are the different types of e-filers that are there and how do you become an e-file authorized provider. And then once you become an authorized e-file provider, what is your roles and responsibilities? How would you protect the data? What are the rules and regulations that you should be abiding by in order to make sure that you have all the internal controls in place so that you can be compliant with the rules and regulations. So that's all we are going to cover in the first topic. So today we will discuss about the return preparers and we will discuss about the positions and disclosures. Tomorrow we will do preparer penalties, a statute of limitation, and if we have time, we'll do the e-filing process. Because this is my first class on this subject, we will not, I'll not give you a lot of download of information, but we will try to go slow in the first two classes. And then, once we are familiar with a lot of tax terminologies that we will be using, we will be familiar with some of the structuring of the course, we will speed up. So today also, we will not be doing any questions that for the content that I will be covering in the class. I will be just explaining you the concept and then, take questions from the audience. And when we start our class tomorrow, we'll do a quick revision of what we have done today, do the questions pertaining to that topic, and then move on to the preparer penalties, statute of limitation, and the e-filing process. Sounds like a plan? Yes, no, maybe? All right. I always see yeses. Nobody says no. That's a good thing. All right. So now one more caveat, and which is very important, that I'm sharing my screen. Just let me know if you're able to see my screen. All right. Now, please remember that the slides that I'm using to teach is not something that you should be referring. Is because, I am just going by the pointers. I'm already aware of the course. So I will be able to give you, I can take up a pointer and give you more information on it. But you, as someone who's going to write the examination, you should read the book that Simandhar has provided you and be very thorough with the content that is there in the book, because just going through the slides and my lecture is not enough for you to prepare for your examination. So you have to go back and read the content that is there in your book. Do the questions, in the LMS software that we have provided. And that's when you will be fully prepared to write the examination. So that's just a caveat that I want to throw before we get started. All right. So as I mentioned, that first we are going to learn who is called a tax return preparer. Now, anyone who has a PTIN, that is personal tax identification number, and anyone who is compensated to prepare the tax return is called a tax return preparer. Okay, so you do not have to be a EA, or you do not have to be a CPA, or you do not have to be a attorney or a lawyer in order to be called as a preparer. Anybody who is preparing a US tax return, it can be a business return, it can be an individual return, anybody who is getting compensated to prepare the tax return is called a tax return preparer. Now we will come across two terminologies here. One is who is a tax return preparer and who is a tax practitioner. There is a difference between both the terminologies. A preparer is someone who's getting compensated to prepare the tax return, whereas a practitioner is someone who has the authority to practice before the IRS. So in order to be a practitioner, you will have to have certain kind of credentials. So that credentials can be in the form of you having qualified education. So that means you can either be a EA or a CPA or an attorney or an actuary in order to be a preparer, right? So a practitioner. A practitioner has more rights to represent the client in front of the Internal Revenue Service than a preparer. A preparer is just someone who is preparing the tax returns and getting compensated for that work. Now, is everyone aware of Internal Revenue Service? I have used this word quite a bit in the last 10 minutes. So can you let me know when I say Internal Revenue Service, what do I mean by that? I have 79 people. I expect at least someone to know this answer. Tax Authority, US Government for Taxation. Okay, all right, great responses. Yes, that is correct. So in the United States, Internal Revenue Service is the government body that looks after the tax system in the United States. So they are the ones who are, writing the Internal Revenue Code. They are the ones who are publishing, instructions on how to file the form. They are issuing notices. So they are the body that governs the US system, US tax system, right? So whenever I'm using the Internal Revenue Service, or sometimes I'll use the abbreviation of IRS. That means I'm referring to the body that is governing the tax system in the US. All right. So coming back to what I was trying to explain you, that a practitioner will have more rights to practice or represent their client in front of the Internal Revenue Service. All right. So PTIN, as I mentioned, that a preparer's tax identification number is required for someone who is preparing the tax return. Now, there can be a person who is preparing the tax return and signing the tax return, and there can be a non-signing tax return as well. All right. What I mean by that is, let's say that we are preparing a tax return for an entity, and that entity is having 50 partners in it. Okay. So usually how it works in any organization is that there will be a staff who will be preparing the work paper. Then there will be a senior who will make sure that the work papers were prepared correctly and will do a review of the work paper. Then there will be manager who's going to do a substantial review of the work paper, just to make sure that anything that was substantial on the account is being taken care of. And there would be a senior manager or a partner who's going to have an overlook of the return, look at the main big ticket items, and then sign the tax return. So how many people are involved in preparing the tax return here? We have a staff who's involved, we have a senior who's involved, we have a manager, and we have a partner who's signing the tax return. So a person who's not signing the tax return, but is involved in preparing the substantial portion of the tax return is also a preparer. A person who's signing the return and looking at the overall substantive accuracy of the return is also a preparer. So not necessarily the person who is signing the return is only called a preparer. A person who's not signing the return, but substantially preparing the most part of the tax return is also a tax return preparer. Okay, so you will see that in the organizations which does tax compliance, all right, you will, Venkat, again, I'm reiterating that I will come back and answer all your questions. So please keep a note of your questions and post those questions once I'm explaining the concept, because it's difficult for me to focus and look at your questions at the same time. All right. So going back to the person who's not signing the return, so someone who is substantially preparing the major part of the tax return is also called a return preparer. Okay. Now, everyone is supposed to have a personal tax identification number, and you will see that in the organizations which are doing compliance, they will make sure that everyone gets a PTIN who is working in the tax field. All right. So it's like an year-end activity. At the end of the year, everyone has to renew their PTIN, because you have to renew your PTIN every year. Or if someone is joining the organization in between the year, the first thing that the compliance team is going to do is they are going to make sure that you have the personal tax identification number. So PTIN is a must if you are doing compliance, or if you are helping in the preparation of the tax return. But how do I define a preparer? Again, the definition is very simple. Anybody who's getting compensated to prepare a tax return is called a preparer. Okay. All paid tax preparer, including your attorney, CPA, enrolled agent, must have a PTIN in order to prepare a federal tax return. So that's like a mandatory. And if you don't, if you don't have a PTIN, and if you don't sign on a tax return, then there are penalties associated with it. What are those penalties? We will cover it in the section in the next class when we discuss about the preparer's penalties. Now, once we are aware that who is a practitioner or who is a preparer, we should also know who is not considered as a tax return preparer. And this is equally important. So let's say that you hire an intern who is just replicating the data that you have in the book in the software. Okay. So someone who is just typing, or who's just reproducing the data, or who's just assisting you mechanically, they are not doing any substantial preparation of the tax return. Now that person cannot be treated as a return preparer. So when you hire interns to just, you give them just random work, okay, just get this, a print of this, or just copy paste this information, you cannot term them as tax return preparer. Now, there is a voluntary income tax assistance program that is established by the IRS. So someone who provides tax assistance under the VITA program, that is Volunteer Income Tax Assistance Program, that person is also not considered as a tax return preparer. Okay. Another person who will not be considered as a preparer is if you are as an employee preparing the tax return for your employer, and he or she is regularly and continuously employed with that employee, then you are not considered as a tax return preparer. If someone is preparing a return as a fiduciary. Now, what is a fiduciary? Again, this is a terminology that we have bumped into. So in the United States, there are different kinds of taxation. So we certain times establish trust for the benefit of a beneficiary. So parents can set up a trust, for the higher education of their children's. And they will also appoint a fiduciary who will look after the functioning of the trust and make sure that the trust is established or operating for the benefit of the children. So someone who's appointed as a beneficiary, as a fiduciary, is a person who's responsible to make sure that the trust operates as is written in the agreement. Also, sometimes what happens is that when someone passes away in United States, we have the estate taxes. Okay, an estate is formed, a fiduciary is appointed, and then he is responsible to allocate the assets of the estate to the beneficiary who are listed in the will. And if there is no will, then as per the laws of the state. So this person who is appointed in a trust or in an estate to help facilitate the distribution of the assets, if this person is preparing a return, then he is not considered as a tax return preparer. Okay. And if you are preparing a claim for a refund for a taxpayer in response to any notice of deficiency or any response to any waiver of restriction after the commencement of an audit, then also you are not treated as a tax return preparer. So I'll give you a little bit more information about the last point that I have explained. So first thing that you do is you prepare the initial tax return. Okay. So if you are preparing a tax return and the tax return gets audited, the IRS may come and assess you with additional taxes, or there may be other notices that can be associated with tax return. So if you hire someone to respond to that notice of deficiency, deficiency again is a terminology that we have bumped into. The literal word of deficiency means that something is lacking. So notice of deficiency means that either you have not paid your taxes correctly, you have understated your income, or you have overstated your expenses, or you have not done something that was supposed to be done. So if someone is helping you to respond to that notice of deficiency, or someone is helping you to claim a refund on the return that you already filed, then that person is not treated as a tax return preparer. Also remember that whenever there is a law, there is an exception to the law. So the IRS is saying that anybody who gets compensated to prepare a tax return is a preparer. But we also need to know who are the certain people who will not be treated as a tax return preparer. Okay, so there are exceptions to this definition as well. As I mentioned, that you need to have a PTIN and you need to sign on the tax returns that you are preparing. Venkat, the screen is not stuck. I am still on the same screen. So as I mentioned, that these slides do not have a lot of information. They are just for me to teach you. But whatever I'm explaining you right now, if you go back and read your book, all that information is listed there. All right. The next thing that we are going to do is learn about the tax return requirements. That means if someone is preparing the tax return, what are the few things that they should be doing? First is that they should sign the tax return. Unless it is spelled by the IRS that you don't need to sign, you need to sign all the tax return. Okay. You must enter your PTIN on the return. So as I mentioned that anybody who prepares the tax return has to have a PTIN. So you should mention a PTIN on the tax return. You should give a copy of the tax return to your taxpayer when you are presenting that copy to the taxpayer to sign on the tax return. Okay. So remember that if you are filing a tax return on behalf of your taxpayer, the government needs to know that you have authorized this person to file on your behalf. Okay. So in that case, the e-file authorization forms needs to be signed. On the return itself, there will be information for you to enter your details, the ERO details, your PTIN number, and you will also have to make sure that you are giving the original return copy of the return that that you're going to file to the taxpayer when you are presenting that return to the taxpayer for their signature. Okay. So what did we cover so far? First, we covered the definition of a preparer and a practitioner. We covered who will not be treated as a preparer. And now we are looking at the requirements as a preparer that you should satisfy. So you should sign the return, you should provide your PTIN, you should provide a copy of the return to the preparer, to the taxpayer when you are giving the return to the taxpayer for signature. Okay. Now there's also a record keeping requirement. So remember, as I was mentioning about the statute of limitation. So because you are preparing a tax return, you will have to make sure that you are keeping the records of the person for whom you have prepared the tax return at least for 3 years after the close of the tax return. Okay. So let's say if you have filed the tax return on 17th Feb 2024, you have to make sure that you keep the returns at least 3 years from the date you have filed the tax return. Okay. Now, in what format can I retain the information? Either I can keep a copy of the tax return that I have filed, or I can keep in record the name of the taxpayer, the taxpayer ID number. Now, when I'm referring taxpayer here, a taxpayer can be an individual, a taxpayer can be an entity can be a partnership, a corp, a trust, an estate. So, name of the taxpayer and the taxpayer's ID number. So usually in United States, if you are an individual, you will be given a social security number, which is very similar to the PAN number that we have in India. And if you are an entity, you will be given a EIN number, entity identification number. Okay. So based on whose return you're filing, if you're filing an individual tax return, you should keep a note of their SSN number. If you're filing a copy of the entity, then you should be keeping a note of their EIN number. So name, ID number, the tax year for which you are filing the tax return, the type of return you are filing. So these are the major record keeping requirement. So if you keep a copy of the return, you are good to go because that's going to have all the information. The copy of the return is going to mention the year, the type of the return you file. It will also have the taxpayer's name and the identification number. But in case you choose not to do so, then these are the few things that you should do in order to make sure that you satisfy the record keeping requirement after you have filed the tax return. Okay. Then we move on to the tax return preparer definitions. This is something that we have already covered. Okay. Preparer penalties. Now, before we discuss about the penalties, I would like to explain you the certain authority or standards that you should be abiding by. If you do not satisfy those standards or if you do not satisfy those requirements, that is when you get hit with penalty. So, before we actually go into the penalty, we should understand certain definitions. We should understand certain standards, and we should also understand the disclosure requirement. Okay. So, first, I'm going to explain you the different authorities or standards that are there in United States when you are preparing a tax return. Okay. So there are three standards. One is reasonable basis. The second is a substantial authority. And the third is more likely than not. Okay. We need to understand the definition of all the three standards of authority. Reasonable basis means, now as I mentioned, that please don't get too bogged down with all the terminologies that we are covering. I'll try to decode and explain you these terminologies as much as I can, because this subject is about, the do's and don'ts. So it will come with a lot of law language and it will come with a lot of tax terminologies. So reasonable basis, which is the standard, which is the most lenient standard, says that whenever you are preparing a tax return, you should at least reasonably believe that whatever you are doing is correct. And if your position is upheld in the court of law, if your position is questioned in the court of law, then there should be more than 20% chance that the court is going to, consider your position as valid. Okay. So that is the reason this standard is the most lenient standard. So that means that your position is not frivolous. You have not taken a position that is not even mentioned in the code of, in the Internal Revenue Code. So if I have to give you an example, let's say that someone moved to United States for work. Okay. And they stayed in United States for 3 years. Ideally, they would meet the substantial present test. And if they satisfy the substantial present test because they have stayed in the United States for a couple of days, they are required to file a tax return in the United States. Now, if someone, like, if that person is, let's say, from, India or from Pakistan or from any other country, and they claim after working in United States for 3 years that they should not be subject to taxation in United States because they are the resident or citizens of a different country, then that's a frivolous position. Because now they are keeping a blind eye to the rules and regulations that are set up in the country where they are going and working. Okay, so someone taking a position that they are not subject to taxation just because they are the resident or citizen of another country, it is considered a frivolous position. So reasonable basis means that you reasonably believe that whatever you're doing on the tax return is correct. And tomorrow, if your position is being questioned by the court of law, if you are being questioned by the US tax court, or the district court or the court of federal claims, there is more than 20% possibility that whatever position that you have taken, the court is going to honor that position. Okay. The second standard that we have is the substantial authority standard. Okay. Now, substantial authority is more stringent standard than reasonable basis, because in order for you to have a substantial authority, you should base your opinion by reading a authoritative literature. Okay. Now, again, a lot of law language that I've used here, that you need to have an opinion and you should base your opinion by reading authoritative literature. Authoritative literature means if we have to decode the word, which means that a literature which has authority. Okay. So let's say that Internal Revenue Service has written Internal Revenue Codes, the code sections, or the Internal Revenue Code or the Treasury has published revenue procedures, or they have published revenue rulings, which basically gives you more in-depth information about the code that they have written. Okay. So substantial authority means that you have taken a position by relying on the literature that has authority. That means literature which you read and on which you can rely, which can be in the form of revenue procedures, revenue rulings, any notices that are issued by the IRS, like the body which has the authority to govern the tax system in the US. If you are basing your position based out of that, then that's substantial authority. And substantial authority means that if your position is questioned in the court of law, then there is more than 40% chance that your position will be upheld. That means your position will be honored. Okay. And the most stringent standard that we have is the more likely than not standard. So more likely than not standard means that you have to base your position in a way that if you are being questioned tomorrow by the court of law, there is more than 50% chance. There is greater than 50% chance that your position will be upheld in the court of law. That means your position or the the opinion that you have taken, that will be honored by the court of law. So more likely than not standard is basically where the Internal Revenue Service believe that there is a scope of tax avoidance or there is a scope of tax evasion. Okay. So let's say, I'm getting into a structure where I'm keeping my parent company or where I am capitalizing all my intellectual property in Cayman Island. I know Cayman Island have almost negligible tax. I know that United States have 21% tax. So if I am routing all my profits to a jurisdiction where there is negligible tax or where there is no tax, because that's why they are called as tax havens. So if I'm taking that position, or I'm doing a structuring in a way where my profits are all going to sit in a jurisdiction where there are no taxes or very less taxes, then those kind of positions or those kind of structurings should have more likely than not standard. That means if tomorrow Internal Revenue comes and questions me that why did you do this kind of structuring? Why did you route your profits to a jurisdiction where the taxes are so low? If my position is questioned, there is more than 50% chance that the court is going to honor my position, maybe because I've relied on the rules and regulations. I have complied by what is listed by the IRS. Okay. So why it is important for us to know the standards? First is there is a disclosure requirement based on what standard you are taking on a return. And second, if you do not meet these standards and if you do not disclose these standards, there could be a penalty that could be associated with it. So, repeating once again, reasonable basis means at least there is more than 20% chance that what you've done is correct. Substantial authority means, as the name suggests, that you have relied on authoritative literature or you have relied on valid resources in order to take your position or in order to get into a transaction which you believe is as per the rules and regulations that are listed by the IRS. And if your position is questioned in the future, there's more than 40% chance that your position will be upheld. And more likely than not, standard is usually for the transactions which are considered as a tax shelter transaction, or the transaction where you're trying to evade or avoid the taxes. So that if you're taking that kind of possession, then there should be more than 50% chance that your position will be upheld by the court of law. Okay. So frivolous position, as I mentioned, that something that is not acceptable at all, something that any person should know, but they're just keeping a blind eye to it. So one example that I gave is, someone moving from abroad to United States, staying there for a couple of years and then claiming that they are not subject to taxation in the United States. Just because they are resident of a different country does not make sense at all, because you're staying in United States and you're generating revenue there, you're making money there. You still have to file a tax return, or maybe you will have to file another forms to claim the treaty benefit. You have to at least legally justify your position. You cannot simply say that I'm not subject to taxation because I'm a resident or a citizen of a foreign country. Okay, so that's a frivolous position. Frivolous position can also be that certain income is subject to taxation, but you argue that that income is not subject to taxation. Okay, so that is something. Frivolous means that something that is not even worth a debate. That someone will not even spend time debating that position. Okay. More likely than not, standard I've already explained. So let's now understand a little bit about reasonable basis. Now, reasonable basis is the standard which is least stringent, but it is also equally important because many a times, if you have a reasonable basis to believe that what you've done is correct, you can avoid lot of penalties that are associated with it. Okay, so I can give you an example. And reasonable basis, all these standards are applicable for the tax practitioner, the person who is the tax return preparer, who's preparing the tax return. Okay. Now, reasonable basis, one of the examples that I can give is that you are preparing the tax return for an individual. Okay. Now, the law says that if an individual is doing charity and they are doing a non-cash charity. So let's say that I have a lot of branded bags and I want to gift those branded bags to charity and then take a charitable contribution deduction, because deduction is going to reduce my tax liability and my tax, my taxable income and my tax liability is going to go down. Now the section 170, which talks about the charitable contribution deduction, it clearly says that if you do a non-cash charity for over $500, you should fill out certain form and provide that details on that form. Okay. So if I am your return preparer, I should reasonably believe that I have filled out that form, or I have asked the taxpayer to give me the details so that I can fill out the form on their behalf, or I have reached out to the taxpayer to get receipts of the payments that they have done. So I reasonably believe that whatever I have done is correct. Okay. So at least, I will be able to sustain my position, or I can say that I have abided by the rules and regulations. I've read the publications, and based on that, I have, prepared the tax return. Sometimes what happens is that the taxpayer will say that they have done a charity of $10,000. Okay. Now, as a tax return preparer, your responsibility is to prepare the tax return. But the ultimate responsibility to pay the taxes and to file the tax return is with the taxpayer itself. Okay. So let's say that the taxpayer tells you that he's done a charity of $10,000, and you keep asking for the receipts, you keep asking for certain kind of proof that he has done the charity, but the taxpayer is not ready to give you any proof. Okay. Then you may still go ahead and file the tax return, and you can mention that on the notes that you relied on the conversation that you had with the taxpayer, and you explained the taxpayer about the penalties that can be associated if the information is incorrect. So as long as you are doing your part, because you can do, as a preparer, you can only do things to a certain extent. As long as you explain the taxpayer about the penalties, if the position, if the deduction is not correct, and if you explain them about the repercussions, and you still go ahead and file a tax return, we can say that you still had a reasonable basis. Okay, so now that we understand the standards of authority, the next thing that we are going to understand is, when do you need to disclose these authorities? Okay, now in order to avoid any penalty, so if you do not want any penalty to be associated when you are preparing the tax return, now there are different kind of penalties. There can be accuracy related penalty. We will discuss about accuracy related penalty more. Under accuracy related penalty, we have the negligence penalty, we have substantial understatement penalty, you know. So in order to avoid those penalties, sometimes you have to disclose the authorities that we have spoken about. So if you feel that you have a reasonable basis for preparing the tax return, then you should go ahead and disclose it on the tax return. If you feel that you have substantial authority, then there is no disclosure that is needed. And if you are entering into a transaction which the Internal Revenue Service believes that it's a tax shelter transaction, or it's a transaction where there is a possibility of tax evasion, then you should have more likely than not standard, but you don't need to disclose it. Okay. So disclosure is required when you have reasonable basis, but disclosure is not required if you have substantial authority and when you have more likely than not standard. Okay. Now, how do you disclose the position? You file form 8275 to disclose your position, and you file form 8275R if your position is contrary to the Treasury regulations. So if you believe that whatever stand you have taken is correct, but maybe there are no adequate rules and regulations regarding the position that you have taken, so that in that case, you can file form 8275. Okay. Now, even though if you are disclosing your position to the Internal Revenue Service, you can still be assessed with accuracy related penalty. Just because you're telling the IRS that you are doing, you're taking a certain position, or you are informing them about your position, that does not saves you from the penalty that can be associated for any misconduct. Okay. So even though you file a disclosure form, there can be a penalty if you are negligent. Okay. So now we have to understand what is the definition of negligence. What do you understand by the word itself? Anyone who would like to try, you can put your responses in the chat window. Ignoring certain things. All right. Come on, what is the literal meaning of negligence? Okay, being careless, absolutely. What else? Those are some great responses. Ignoring things which are easy to understand, missing something without knowing. All right. Yeah, I would say those are great responses. So negligence means that, you do not make reasonable attempts to comply with the rules and regulations. So let's say that today I am handling something that I'm not aware of. Okay, so let's say that I prepare business tax returns, and I have got a tax return for a person who has a parlor. Okay. So I am going to make reasonable attempts to understand the kind of business that person is running, because then I will be able to see whether the deductions the person is claiming are, necessary and ordinary business deductions. If I come across certain deductions that are personal, I have to tell the taxpayer that these are personal expenses and you cannot claim it on your personal tax return. So I am actually making reasonable attempts to make sure that I understand the expenses that they have listed for the business, and also making an effort to bifurcate the business expenses and the personal expenses. So if I fail to exercise ordinary and reasonable care when I'm preparing a tax return, that is when I am treated as negligent. So that means I have failed to comply with the rules and regulations by not making reasonable attempts to understand the taxpayer needs or to understand the tax return that I'm trying to file. Okay. You can also be assessed with an accuracy related penalty if there is disregards for regulation. Now, you can actually go with the literal English meaning of these words. What do we mean by disregards for regulations? What is regulations? The law, the rules, absolutely. The code sections, the authoritative literature, right? So if you do not consider the literature, authoritative literature, the rules, the regulations that are set out, you have a complete disregard for those regulations, then you will be assessed with an accuracy related penalty. You can also be assessed with an accuracy related penalty if there is a substantial understatement of income tax on a tax shelter item. Now, what do we understand by tax shelter? I'm sure everyone would have heard about tax shelter transaction. So what are we sheltering here? Tax savings. I will say, tax savings can be done in a legal way, but tax sheltering is somewhere, where you adopt unethical means, or that's something that you're trying to use the loopholes in the law to avoid the taxes. So tax shelter transaction could be, one of the examples that I can give you. And this has been used left, right, and center by the people in the US, and there are a lot of regulations now pertaining to this transaction that, okay, someone says Vijay Mallya. That's really funny, Gaurav. So let's say that I like horse riding. Okay. I'm just giving an example, not that I really like horse riding. I've never done it in my life. So let's say I like horse riding and I have a stable and I have a farm where I have kept my horses and it's a hobby for me. Okay. Now I may want to put that hobby and put it as a like a like a business. Okay. So why do you enter into a business? What is your core, I would say, focus there? To make profits. Absolutely. Right? So you are entering into the business to make profits, but you did not enter into horse riding to make profits. That's a hobby for you. Okay. So what people do is they will put this up as a business setup and they will try to claim all the deductions that they can possible as a business deduction, and they can set off these deductions or losses of one business against the profits that they are making from the other business. Okay, so it's a tax shelter transaction. What you're doing here is you are converting your hobby into a business, and then you're trying to claim the losses because obviously you've not set up this business to make profits. This is your hobby, so it doesn't matter whether you're making money or not. So this is a tax shelter transaction because actually it is not there to make profit. And second is that you're using the losses of these businesses to set off the income from the other businesses, and you're also reducing your tax liability and not paying taxes. Okay, so there can be a lot of tax shelter transactions. I mean, we don't want to get into that area right now. But what I'm trying to explain you is that there can be substantial understatement of the income taxes. Understatement means that you are not paying your taxes on the actual income. You have understated that income by doing tax shelter transactions. So then also you can be assessed with a accuracy related penalty. If there is a valuation misstatement. Now, what do we understand by valuation misstatement? Uh, Again, I'll give you an example that as an individual, you can claim for the charity that you have done. You can claim charitable deduction and you can reduce your taxable income. So let's say that I have a very old painting. Okay. Now, I will usually hire an evaluator to evaluate what is the value of my painting if I'm giving that painting to a government agency for exhibitions and all that stuff. Okay. So now let's say that the actual valuation of that painting is only $10,000. But I'm claiming $100,000 on the tax return. So claiming 100 times more than the actual value of the painting. So that is valuation misstatement. Okay, so I am misstating the value of the deductions which I should actually be taking on my tax return. Substantial overstatement of pension liabilities. Now, this is a concept which is more applicable to the entities. So, your companies which establishes the pension plans, if they overstate your pension liabilities. Okay. What happens when you overstate your liabilities? What happens, people, when you overstate your liabilities? Okay. All right. So those are great responses. Again, there can be a where you are overstating your liabilities. That means, liability is again an expense to us. So there can be a penalty associated to it. And then if there is any substantial estate gift tax valuation understatement. So to explain you the last point, let me put it across this way, that in United States, if someone is giving you a gift, the person who is giving you the gift is subject to taxation. Okay. So if you are, understating the value of the gift, so what you're doing, so let's say that the house that my dad has gifted me is worth $100,000. Now he is subject to pay taxes on that $100,000 of gift that he is given. But what if he understates the value of the gift and say that the house is only for $50,000? He'll only pay less taxes on it, right? So if there is substantial estate or gift tax valuation, estate is nothing but when you are alive, you give gifts. When you die, an estate is formed, and then your property and your assets are distributed based on your will. And if you don't have the will, then whatever the state law says, the property is distributed to the beneficiaries accordingly. Right? So interstate, yes, that's the word, Rahul. Thank you so much. So, there could be undervaluation because of that, and then you can be associated with penalties related to that as well. We also need to understand the definition of fraud. Negligence is different and fraud is different. When do we say that this person has done fraud with me? When do we use such a big word? It's a heavy word. Intentional, willful, right? Fraud is deliberate. Thank you so much, Vignesh. You've used a great word. Knowingly, absolutely, right? So when I am willfully trying to deceive someone, okay? When I know that what I'm doing is not correct, but I'm still doing it. So that is fraud. So it's a act which is deliberate, which is intentional, which I know that I'm doing it with consciously, with knowing that it is not a correct act. That is when we term it as fraud. So eventually, when we progress towards the syllabus, you will see that negligence will have penalties associated with it, but fraud penalties are even much heavier, and fraud can also lead to criminal penalties. So there are civil penalties and there are criminal penalties. Can anyone tell me what is the difference between a civil penalty and a criminal penalty? Civil penalty and a criminal penalty. Okay, not sure. You can at least try. Right. So that's exactly the word that I was looking for. So when we say criminal penalties can be in the form of monetary fines, and there could also be jail time. So you can also be put behind the bars. Civil penalties are mostly penalties which are associated with monetary, financial penalties. And they can also be like they can take your license, or they can, disbar you or suspend you to practice in front of the Internal Revenue Service. So those kind of penalties, but not necessarily putting you behind the bars. Okay. So now we have understood the different standards. We have understood what is negligence. We have understood what is fraud. We've understood what are the disclosure forms and what happens if you file the disclosure forms. What are the some scenarios where you will still be assessed with the accuracy related penalty, the scenarios that we have discussed. We'll also discuss about what is a tax evasion and what is a tax avoidance. Okay. First, let's understand what is tax avoidance. Now, tax avoidance is something that we all try to do, right? So what are the few things that we do in order to avoid tax? Now, tax avoidance is legal. Huh? It's not illegal. Like you can Use the benefits that are listed in the law to avoid taxes. Tax planning, claiming deductions, betting. Not really. Taking the deductions and exemptions. Sometimes you can, uh, I would say, Shayantan not taking more deductions, but maybe accelerating your deductions and deferring your income, right? Because you may use the time value for money. So let's say if you are in a position to buy a machinery today where the tax rate is 30%, and let's say you know that next year the tax rate is going to go down and it's going to be 20%, which year would you like to buy more equipments? Which year would you like to pay your expenses, uh, accelerate your expenses? Obviously, in the year where you have more taxes. Why next year? In the year where you have the tax rate which is higher, that means you are going to get more tax benefits because the deductions or the expenses is going to reduce your tax liability and your tax rate is 30%. So why next year? Obviously, I would like to accelerate my expenses in the year where the tax rate is higher because I will be able to reduce my taxable income and pay less taxes. Make sense? Let's say that I am in a position to execute a transaction run recognized income in the month of December or in the month of January. Okay. I know that in the month of December, the tax rate is 20%, and in the month of January, because I will have higher income, my tax rate is going to be 30%. So which year would you like to execute that transaction? Now, this is an income. This is not an expense. So which year would you like to execute the transaction? You would like to execute the transaction in the month of December, in which the tax rate is lesser, because income means that now you will have a higher taxable income, you will end up paying more taxes. So, if I have the choice, I will execute the transaction in the year where the tax rates are lesser. So those are the few examples of tax avoidance. That means you are shaping your transactions in a way where you can pay less taxes. Okay. Avoidance is not a criminal offense, but again, there are certain transactions which are tax avoidance transactions, which the IRS may believe can lead to a tax evasion or an avoidant transaction. So there is a disclosure requirement for that as well. Okay. We'll learn about the listed transaction and the reportable transaction eventually. So I'll explain what is a listed transaction, what is a reportable transaction as well. Now let's understand what is a tax evasion. Tax evasion is again illegal. So evasion is an act to deceive, sabotage, camouflage, conceal, or do something in order to not pay taxes. Okay, so me getting into a structure where I am putting in all my profits in a jurisdiction which has negligible or very tax rates like a Cayman Island or a Mauritius or a Luxembourg. These are all my, they are tax havens, and I'm trying to, move my income to the jurisdictions where I have to pay less taxes. So that can come as a tax evasion, and camouflaging the structure, or I'm sabotaging the structure in order to uh, conceal my income and not pay taxes on it. So intentional understatement or omission of income. See, you will have to focus on the words that they are using under each definition. So when we learned about fraud, that was willful, it was intentional. Here, when we are learning about evasion, that means you are intentionally understating or omitting your income. You are claiming fictitious or improper deduction. There is false allocation of income. What is false allocation of income? So, let's say someone is not required to get income, but you're allocating income to that person. Okay, improper claims, credits, and concealment of assets. So obviously, if you do not disclose your assets, will IRS ever get to know that what income you generate from those assets? Let's say that as a US resident, you have 10 houses in India and you are generating rental income from all the 10 houses. All the rental income is in the form of cash and there is no bank transactions and you have your own ways to get that money to the US. If you do not disclose those 10 houses to the United States, what are you doing here? You are concealing your assets. So they will never get to know that you have those kind of assets in India and you are generating that kind of revenue in India. Okay. Then we have the standards that you should follow if you are taking a tax shelter position. So what is the standard which we need to follow if we are taking a tax shelter position? Tax shelter position means that the IRS believes that you're trying to evade the taxes. So what are the three standards that we covered? We covered reasonable basis, we covered substantial authority, and we covered more likely than not standard. So if it's a tax shelter position, which IRS believes, then the standard that you should be following for those transactions is more likely than not standard. Okay. I will pause here and we will do the penalty section tomorrow. So maybe whatever I have taught you today will not make so much of sense because this is a first class and we have come across a lot of terminologies. But just to give you a recap, we have understood who is considered as a tax return preparer, someone who's getting compensated to prepare the tax return. We also covered some of the scenarios where a person will not be considered as a preparer. Because we are talking about the tax returns, we have to make sure that the tax return person who's preparing has a valid PTIN. He's signing the tax return. He's giving a copy of the tax return to the taxpayer when the copy is sent for signature. He's making sure that he is aware of the record keeping requirement. And because he's preparing the tax return, he should also abide by the standards that are laid down by the government. So we spoke about the different authorities that are there and when disclosure is required for those authorities, what are the different forms in which you can disclose your position? What happens if you still disclose the position? What are the certain scenarios where you will be listed with a penalty, even if you disclose your positions? And we learned about certain definitions, which is what is negligence, what is fraud, what is, the different authorities that we have, what is tax avoidance, what is tax evasion. Okay. Now that we have a basic understanding of these terminologies, the next thing that we are going to move on is in tomorrow's class, we will discuss about the penalties. So which means that I know that I'm supposed to do this. But if I don't do this, then what kind of penalties are associated with that act? So we will discuss about all the different kind of penalties under different subsections and sections in tomorrow's class. And also before we dig into the penalties section tomorrow, we will also do some questions on the content that we have covered today. Okay. And as I promised that this is my first class, so I'm not going to download you with a lot of information. I think I have still given you a lot of information about the content that we have covered today. So I'm just going to pause here and now, keep the forum open for the questions that you may have on the content that we have covered today. So feel free to post your questions now and I'll be happy to take it up. Please explain different people involved in TRP. What is TRP? What's the full form? Tax return preparation. Is that what you mean, Kameshwar? Okay, that's a yes. It has a T in between. Okay. So now how many people are prepared in preparing a tax return is a very subjective question. Okay. So let's say that if I'm preparing a tax return for an individual and I don't have a practice, I'm the one who's going to do everything, then the only person that who's there in the preparing the tax return is me. I'm entering the data in the system, I'm reviewing the data in the system, and I'm doing the filing of the tax return. But there could be engagements where the work is, cannot be done by a single person. So you may have a team who will help in the preparation of the tax return. So if it's a business tax return where there are 50 entities, then in that case, the people who will be involved in the tax return preparation, there will be different level of people. There will be staff, there will be senior, there will be managers, senior managers, and partners. So depending upon what type of tax you're preparing, what kind of setup you have, whether you are an entity who's doing the engagement, whether it's an individual who's doing the engagement, it will vary. So there is no, uh, you know, straightforward answer to it. It will depend upon the facts and the figures. Krishna, answer to that is yes. Remember not to put everything in the caps. That's the writing etiquettes that when you put everything in caps, it is meant to be rude. Okay, I'm sure you didn't mean it that way, but do preparer definitely need a PTIN? The answer to that is yes. Then we have a question from Gautami. Can you please explain again about fiduciary with examples? So, Gautami, let me say that I appoint a Goldman Sachs. So, Goldman Sachs can be appointed as a fiduciary for me to run my trust. So, they are basically the people who will be responsible to make sure that my beneficiaries are getting the income or the distribution of the assets as and when they are designated to get that, right? So if Goldman Sachs is preparing the return, the tax return for the trust, then they would not be considered as a preparer because they are preparing the tax return in the capacity of a fiduciary. Does that make sense? Okay. So Nishita is saying, you're saying that in December, the tax rates are low, which are utilized for tax avoidance. I didn't understand that point. Can you please explain? Okay. So, Nishita, what I'm trying to say is that you try to accelerate your expenses when the tax rate is higher, and you try to defer your income in the year when the tax rate, given the time value of money and also depending upon the tax rate. Okay. So let's say in the year 2023, the tax rate is 30%. And the year 2024, the tax rate is 20%. If you are going to have a similar kind of income, you would like to take more deductions if you are allowed to in the year 2023 rather than in the year 2024. So if I have to put this in the perspective of an example, let's say that you can do charity, you want to do charity for $10,000. Okay. So now you know that if you do charity in the year 2023, it is going to reduce your taxable income by $10,000. And on that income, you will have to pay 30% taxes. You also have the choice to do the charitable deduction in the year 2024. But if you do charity in the year 2024, your income will only be subject to 20% taxes. So which year do you think it makes more sense to take the charitable contribution deduction. Obviously, in the year where the tax rates are higher. So that's what I was trying to explain, that you would try to accelerate your expenses in the year where the tax rates are higher, and also use the time value for money. Can you please explain the notice of deficiency and difference between? Okay. So notice of deficiency is different. So some people are posting their questions in the direct message to me. So the people who are sitting in the who are looking at the chat will not be able to see this question. So I would encourage everyone to post the question for everyone. So Sajid has put a question asking that please explain notice of deficiency and the difference between Form 8275 and Form 8275R. Now, these two are separate. Notice of deficiency is basically a notice by the IRS. Either it can be because you have not calculated your taxes correctly, either it can be because you have not made your estimated payments, or it can be because you have understated your taxes or you have overstated your deduction, or it can be that something is not right with your tax return. So whenever you get a notice from the government, that is called the notice of deficiency. Means something is deficient in your tax return. That's the reason you're getting a notice from the government. Now, what is Form 8275 and 8275R? This is the form that you fill out as a practitioner or as a preparer, or the taxpayer itself if you're preparing your own tax return, because you want the authority to know what standard you have taken on the tax return. If you reasonably believe that whatever you have done is correct and the position is not contrary to the Internal Revenue Service, you can fill out Form 8275 and say that I have a reasonable basis on which I have prepared the tax return. So 8275 and 8275 are the disclosure forms which you fill out to inform the authority of the standards that you are abiding by or the standards that you're taking on the tax returns. Okay, so we have another question from Sudhanshu. You mentioned preparer is any person who is getting compensated for it, and they do not need to be a EA or CPA, which required for a tax practitioner. So my question, how will we differentiate both? What is the trick here? So I would say, Sudhanshu, it's very simple. Anybody who's getting compensated to prepare a tax return is a preparer. But in order to be called as a practitioner, you have to satisfy certain requirements. That means it can be in the form of credentials, or it can be other rules and regulations that are set out by the IRS. So let's say that I am a CPA, so I satisfy the requirement of a practitioner because I have the credentials that are needed for me to practice before the IRS, right? Now, if I am also preparing the tax return, what will you treat me? Will you treat me as a preparer or will you treat me as a practitioner? And I'm getting compensated for preparing the tax return. You will treat me as both. I can be a preparer and I can be a practitioner. But let's say someone who's not a EA or a CPA or does not have the required qualification, but they are preparing the tax return. In that case, they will be called as a preparer. They will not be treated as a practitioner. Ma'am, does any paper have topics related to 1120 RIC tax for our exam? Jignesh, again, you will have to see the second paper of your enrolled agent, that is business paper, and see if 1120 RIC is part of it. I'm not aware of this, so I'll not be able to answer this question.
Okay, Jaya has a question. Can you please explain about substantial authority with examples? Jaya, I do believe that I had given examples, when I was explaining substantial authority, but I can do that once again. So as the name suggests that substantial authority means that you are taking a deduction or you are taking a position on the tax return by reading supporting documents or by reading the law. So let's say that today if I am, I see that my client has done certain transaction as a crypto transaction. They are dealing in cryptocurrency. So, because this is not something that I come across frequently, I will try to read the rules and regulations that are pertaining to cryptocurrency. And then, basis that, I will account for that, whether it's going to be a taxable transaction or whether it's going to be a non taxable transaction. So, what am I doing here? I am reading the authoritative literature, or I am basing my opinion on something that has authority in order to take a stand on the tax return. So that's substantial authority. Yes, you don't need the PDF notes from the Simandhar portal. I mean, these notes are just for me to teach you, but you need to go back and read the entire book in order to be ready for the examination. You don't need these notes. These are not notes. These are teaching slides. And you don't need this. You need to read the entire book in order to be equipped to write the examination. Okay, Megha says, is it compulsory to file 8275 or 8275R with the returns? Well, Megha, to answer that question, depending upon the authority that you have. If you feel that you have only reasonable basis, when you are preparing your tax return, then in order to avoid any accuracy related penalty, you should file the disclosure forms. But if you think that you have substantial authority and more likely than not standard, then it is not required for you to disclose your position. Okay, I have already explained more likely than not standard with a lot of examples. Uh, So we have few more questions. Is there a notice of deficiency issued by court? Does it mean that they are prepared by another tax preparer before this is the question? Does it mean that there will be penalty at the same time? So the role of the court is to say which party is correct. Okay, so there'll be two parties. One is the taxpayer and the other one is going to be the IRS. So the court is going to decide if the IRS have assessed the penalties correctly or not. Or they are going to decide that whatever they have done is not correct and the taxpayer is not supposed to pay the penalty. So the court here is deciding on whether this one party is right or one party is wrong. And based on that, they are going to give the decision. All right. So here penalty is not notice of deficiency is issued by the IRS, and court is the one which is just going to decide whether the penalties are appropriate or not. And they may assess additional penalties if they think that the taxpayer wasted court's time or if they feel that the IRS did not do what they were supposed to do. What is the role of a practitioner? Will practitioner represent tax returns that are prepared by another taxpayer before IRS? That's a good question, Priyadarshini. We will cover what is the role of a practitioner eventually as we move forward in our syllabus. But yes, the practitioner gets a bigger role to play and they have the authority, they have unlimited rights to represent the taxpayer in front of the IRS, even if the return is not prepared by them. If someone else prepared the return, they can still go ahead and represent the client in front of the IRS. Yasha, Yash, if you're going to receive the books in April or May, unfortunately, you will have to reach out to Simandhar to see how best you can go about this. Maybe they can send you some old books to prepare while you wait for the new ones to come. Yes, everyone who is involved in the preparation of the tax return should have a PTIN. That's a mandate. Can you please explain on disclosure of position on the IRS, as the preparer only disclose their position on the IRS by filing Form 80 to 75R, or the tax filer too needs to disclose a position? No, they see, when you are preparing a tax return for a taxpayer, you are doing everything for them, right? So the taxpayer is not going to do anything. The tax filer is basically a software which you are using to prepare everything. So as a preparer or as a practitioner, you will prepare everything. You will sign everything on clients. I would not say sign, but you will sign the tax return because you prepare the tax return and do everything. So there's only one person who's taking care of everything. For working professionals, see, enrolled agent is not that a tough examination. So if you dedicate your weekends and study, 8 to 10 hours over the weekend, it is a very easy subject to crack and get certified as a EA. Okay, Mega says that if preparer are not 100% sure on information that they provided on the return, but he took all the steps to verify the information and due diligence, so he should file Form 80 to 75. Again, Mega, here, if the tax preparer believes that the position that he has taken is reasonable basis, then he should file Form 80 to 75 to avoid any accuracy related penalty. But if he feels that the position has substantial authority, then no disclosure is needed. I would say that, after this session, go back and read the content that you have, read the book so that you can get more sense out of it. Because in the class, we will focus on the areas that are important, but we will not explain everything line by line because we are all professionals here, right? Any more questions? Yes, absolutely. You can do part 3 without taking any other part because there's hardly any link between part 1 and part 2. Uh, from next class, if we go, over 1.5 hours or so, I'll also try to give you a breather, like a break for 5 minutes, 5 to 6 minutes. Like a bio breaks. So please remind me in the next class if I miss giving out a break. With that, I think I have taken most of the questions, so we can wrap up the session today. So tomorrow before we meet, we will do some questions on the topic that we have covered today. And then we will study about the penalties and the e-filing process tomorrow. All right. With that, thank you so much, everyone, for actively participating and putting your responses in the chat window. You've been a lovely audience. Have a nice Saturday, and we'll speak again tomorrow. Bye, everyone.